Welcome to The Explainer. We've got an incredibly urgent and honestly fascinating analysis to walk through today. We're looking at these massive, seismic global shifts. We're talking macroeconomics, geopolitics, and most importantly, how these monumental events directly impact your daily finances, your wallet. Okay, let's dive right into this because what we're witnessing right now is a historic realignment. Understanding the ground we're standing on, that's the absolute first step to protecting your wealth. Listen to this quote. An entire nation is humiliating the United States. The German chancellor just delivered this statement in Berlin right in front of a packed room of students. No preamble, no half measures, just straight to it. Now, sitting at home, you might think, well, that's America's problem, or maybe that's a Middle Eastern or German problem. But actually, you'd be wrong. The really critical thing to understand here is that this geopolitical tension isn't just some isolated conflict. It is literally the ultimate accelerator for a profound structural economic shift that's happening right under our feet. And that brings us to the core of our problem today. For the very first time in the entire history of the Eurozone, its two foundational pillars, Germany and France, are cracking. And they're cracking at the exact same time. They've essentially stopped being the undisputed engines of Europe. And here's the harsh reality of it. When giant pillars crack, the weight of the building doesn't just, magically disappear. It shifts, it distributes, and eventually all that weight lands squarely on everyday consumers. It crushes purchasing power, it shrinks savings, and it drives up your everyday bills. So let's look at part one, Il motore europeo se ferma, or the European engine stops. We really have to start with Germany. This is a country that has officially transitioned from being the absolutely unstoppable engine of Europe into this state of structural stagnation. I mean, German GDP is facing a complete standstill. Look at these projections. We're talking growth of just 0.6% in 2026, then dropping to 0.4% in 2027, and basically flatlining somewhere between 0 and 0.4% until the end of the decade. The engine is running, it's burning fuel, but it's producing zero speed. Why? Well, it's a mix of things: a rapidly shrinking working-age population, declining private investment, and this catastrophic 8-year delay in the auto sector's transition to EVs. Giants like VW, BMW, Mercedes, they spent years defending the combustion engine, while international competitors just went ahead and built the future. And this leads us to a massive, glaring contradiction. Right now, Germany is struggling with this 20 to 30 billion euro black hole in its 2027 budget. The government is totally deadlocked over how to fix it. Do they cut spending? Do they raise taxes? Yet paradoxically, they somehow easily found 153 billion euros to fund 460,000 soldiers by 2039. That is Europe's most ambitious post-war rearmament. Now, we're not here to make a moral judgment on that choice. We're just neutrally observing the reality here. An economic bloc has to decide if it's rearming to protect itself or reforming to grow, because doing both at the exact same time seems, well, mathematically impossible right now. Moving on to part two, La trappola matematica francese, or the French mathematical trap. So, if Germany is a stalled engine, France is caught in a mathematical trap. Do you guys remember the Greek debt crisis back in 2010? Greece represented just 2% of the Eurozone's GDP, and it nearly shattered the entire Euro system. I mean, we spent years talking about absolutely nothing else. Now, think about France today. France represents 16% of the Eurozone's GDP. That is 8 times the size of Greece. If a country with just 2% of the GDP almost broke the euro, a crisis in a 16% heavyweight like France wouldn't just be bad. It would cause an uncontrollable, spiraling contagion across all global markets. And the math proves exactly why France is trapped. Get this, public spending sits at a staggering 57% of their GDP. Pensions eat up 14%. And the worker-to-retiree ratio, it plummeted from 5 to 1 back in the post-war era to just 1.4 to 1 today. Now, you might be thinking, well, just cut spending. But here is the trap. It's because of something called the fiscal multiplier effect. Basically, government spending is so deeply tied to the economy's growth that cutting just 1% of public spending in France only reduces the actual deficit by a tiny 0.1%. Every single euro cut crushes growth and tax revenues. So France literally can't cut its way out of debt without triggering a massive recession, with estimates pointing to a potential breaking point around 2031 or 2032. Which brings us to part 3, l'acceleratore geopolitico globale, the global geopolitical accelerator. You see, geopolitical conflict acts as a fatal accelerant to these weak European economies. It strikes the exact points where the system has zero defenses. Consider how modern risk is calculated today. In the early days of recent Middle Eastern conflicts, an Iranian F-5 warplane, a jet literally designed in the 1960s, managed to penetrate a $500 million state-of-the-art American air defense system in Kuwait. It's almost absurd to think about, right? An antique jet casually bypassing $500 million of modern technology. But when that happens, the entire world has to recalculate. Global markets, maritime shipping routes, insurance companies, they all instantly redo their risk models. And that increased cost, it trickles all the way down the supply chain directly to the items you buy every single day.
Then we have this incredible timeline. June 13th, 2025, the International Atomic Energy Agency had a scheduled highly confidential meeting where Iran was supposed to reveal the location of a secret, mountain-deep uranium enrichment site. But on that exact same day, June 13th, 2025, the U.S. attacked Iran. The paradox here is just astonishing. An attack designed to stop a nuclear program actually made that program invisible, totally uninspectable, and far more urgent for the nation developing it. It guarantees long-term structural geopolitical instability. And let me tell you, that is the worst possible environment for long-term investing.
Let's shift gears to part 4, l'impatto sui tuoi risparmi, the impact on your savings. We've been talking a lot about global macroeconomics, but how does this actually drain your wallet? Well, it's all about this chain reaction. Tension in the Strait of Hormuz leads to blocked supply routes and skyrocketing shipping costs. That triggers higher energy prices, specifically for liquefied natural gas. Because energy is expensive, inflation stays sticky. Because inflation is sticky, the European Central Bank cannot cut interest rates as everyone hopes. And because rates stay high, your variable rate mortgage stays painfully expensive, and your winter heating bills go through the roof. Geopolitics is quite literally dictating your monthly household budget. And honestly, it gets even worse for passive investors. You might think you're playing it completely safe with a diversified ETF, a bundle of stocks that automatically tracks the broad market. But these passive trackers are essentially blind. Every single month, your money is automatically buying shares in structurally lagging German giants like BAS, Siemens, Volkswagen, and Bayer. These are companies facing sky-high energy costs and plummeting foreign demand, and they're unable to reform. So your monthly ETF investment might unknowingly be buying into a share of this unreformable structural decline. Furthermore, consider this super counterintuitive reality, the spread trap. You logically think a struggling Germany might make other European bonds look better, right? Actually, no. When the German engine stalls, the perceived risk of the whole bloc goes up. This means the spread, the extra interest countries like Italy must pay to borrow money through their BTP government bonds, goes up too. Refinancing national debt becomes way more expensive, and guess who pays that difference? Yep, everyday citizens, through higher taxes and compressed returns. Okay, part 5. Come defend the portfolio. How to defend the portfolio. Let's talk solutions. So, how do we actively defend our portfolios and survive this era of instability? Let's break down the active management strategy highlighted by our source material. It's highly defensive. Gold sits at 10%, uranium is at 2%, and what's really fascinating here is that the source recently took profits after a massive 160% run since April, scaling the position back to a safe 2%. There's a 2% allocation to crypto, like Bitcoin and Ethereum, strictly based on positive statistical momentum, and 2% in the Swiss franc. Recently, exposure to strong developed markets like Australia was also incrementally added. But the biggest takeaway here is the cash position. Holding a significant amount of cash, in this case 30,000 euros, isn't about timing the market perfectly. It's about psychological peace. It lets you sleep at night. Assets like gold and the Swiss franc are not being used here to wildly speculate or day trade. They are calculated, long-term defensive shields against the devaluation of the dollar and ongoing geopolitical chaos. You monitor the risk on indicators, sure, but you protect the core, ensuring you have a steady foundation that keeps you feeling secure. Which brings us to the end of this explainer and leaves us with one powerful, lingering question. For decades, Europe delegated its security to America, its energy to Russia, and its economic growth to the global market. Now, all 3 of those pillars have collapsed. So who is going to pay the bill for this new world? Governments don't pay bills. They just dilute them. They spread the cost out. Ultimately, it is everyday citizens who will foot this bill through persistent inflation, higher taxes, and compressed savings. The terrain has changed, and understanding it is your absolute best defense. Keep learning, stay vigilant, and we'll see it in the next explainer.